You know, I once watched a trader lose everything in 17 seconds. Not 17 minutes, not 17 hours, 17 seconds. And the most heartbreaking part wasn't the money that disappeared from his account. It was the look on his face when he realized that his stop loss, the very thing he thought would protect him, was actually the weapon that destroyed his trading career. He sat there, hands trembling, staring at his screen, and he whispered something I'll never forget. He said, "I did everything they told me to do. I followed all the rules. So why am I the one bleeding out?" Now I want you to imagine something with me for just a moment. Picture yourself sitting in your trading space right now. Maybe it's your bedroom, maybe it's your kitchen table, maybe it's a little corner you carved out where no one bothers you. You've done your homework. You studied the charts. You analyzed the market structure. You identified what you believe is a high probability trade. Your heart's beating just a little bit faster because you know this one feels right. You place your entry. You feel that rush of commitment. And then, because you're responsible, because you're disciplined, because you've been told 1,000 times that you must protect your capital, you place your stop loss. You put it where the books say to put it. You put it where the YouTube videos demonstrate. You put it where everyone agrees it should go. And then you wait. But here's what happens next. And I want you to feel this because I know you've lived it. The market moves against you. Not dramatically, not catastrophically. Just enough to touch your stop loss. You're kicked out of the position. Your account is debited. And then, as if the market was mocking you personally, as if it knew exactly where you were hiding, the price reverses and rockets in the direction you originally predicted. The trade you analyzed correctly, the move you saw coming, the profit that should have been yours, all of it happens without you. And you're left sitting there with a loss you didn't need to take, watching a win you should have captured, feeling like the market reached into your account and robbed you while you were following the rules. This isn't just frustrating. This isn't just bad luck. This is the silent massacre happening to retail traders every single day, and almost nobody is telling you the truth about why it keeps happening. See, there's this idea that's been sold to you, this concept that's been repeated so many times it sounds like gospel. They tell you that stop losses are your safety net. They tell you that risk management means having tight stops. They tell you that if you just place your stop loss at the right technical level, you'll be protected from disaster. And on the surface, that sounds reasonable. It sounds professional. It sounds like something a disciplined trader would do. But Richard Wyclof, one of the most brilliant market minds who ever lived, a man who studied the actual behavior of money, who interviewed the titans of Wall Street, who decoded how the big players really operate, he saw something that most people miss entirely. He saw that the way retail traders use stop losses isn't protection. It's self-sabotage. He watched traders defeat themselves with the very tool designed to save them, and he warned about it. He wrote about it. He explained the psychology and the mechanics behind why your stop-loss strategy, no matter how textbook perfect it seems, might actually be the single biggest obstacle between you and consistent profitability. Now, before we go any further, I need you to understand something crucial about who Richard Wyckoff was and why his perspective matters so deeply. This wasn't some theorist sitting in an ivory tower drawing lines on charts and guessing about market behavior. Wyckoff started as a stock runner at 15 years old. 15. He was in the trenches of Wall Street before he could even vote. He observed the coupled titans, the Rockefellers, the Carnegies, the real operators who moved millions and millions of dollars. He didn't just read about markets. He watched the tape. He studied order flow before anyone called it that. He interviewed Jesse Livermore. He understood accumulation and distribution not as abstract concepts but as the literal choreography of big money hunting retail positions. When Wyckoff talked about stop losses, he wasn't speaking from theory. He was speaking from watching thousands of traders get systematically harvested. He saw the patterns. He saw the traps. He understood that the market isn't this random, chaotic entity that just happens to hit your stop before reversing. He knew that your stop loss is visible, predictable, and often targeted. Not because the market hates you personally, but because that's where liquidity sits. That's where the fuel exists for the next move. And if you don't understand this fundamental reality, you'll keep donating your capital to players who do. So today, I'm going to walk you through the 5 fatal stop-loss mistakes that Wyckoff warned against. These aren't small tweaks. These aren't minor optimizations. These are fundamental errors in thinking that separate traders who survive from traders who eventually give up and walk away convinced the game is rigged. And here's the thing. After you understand these 5 mistakes, you won't just trade differently. You'll see the market differently. You'll recognize the traps before you step into them. You'll stop being the liquidity and start positioning yourself with the players who actually win consistently. Let's start with the first fatal mistake. And this one is so common, so embedded in trading education, that most people don't even realize it's a mistake. The first fatal mistake is placing your stop loss at obvious technical levels. Now I know what you're thinking. Wait, aren't we supposed to place stops at technical levels? Isn't that the whole point of support and resistance? And that's exactly the problem. That's exactly the trap. See, you've been taught to place your stop just below support if you're long, or just above resistance if you're short. You've been taught to use round numbers, previous swing lows, moving averages, Fibonacci levels, all these clearly defined, mathematically precise, totally logical places to put your stop. And here's the brutal truth. Everyone else has been taught the exact same thing. Every retail trader, every beginner, every course graduate, every person who's ever watched a trading video is putting their stop in the exact same place. So what do you think happens? You think the market just randomly decides to reverse right at that level? No. What happens is this. The big players, the institutional traders, the market makers, they know where those stops are clustered. They can see the order flow. They understand the psychology. And they know that just beyond that obvious support level is a pool of stop-loss orders that, when triggered, will provide the liquidity they need to actually fill their large positions. Let me paint you a picture of how this works mechanically. Imagine there's a stock or a currency pair that's been trending upward. It pulls back to a clear support level. Every textbook trader sees this and thinks, perfect, I'll buy at support and place my stop just below it. Hundreds, maybe thousands of traders do the exact same thing. Now the big money wants to get long too, but they have a problem. They need to buy millions of dollars worth, and if they just start buying aggressively, they'll push the price up and won't get filled at good prices. So what do? They push the price down, just enough to trigger all those stop losses sitting below support. All those stop orders become market sell orders, and boom, there's the liquidity they need to absorb and fill their massive buy orders. Once they're filled, the real move begins, and the price rockets higher exactly as all those stopped-out traders originally predicted. Wyclof called this the shakeout. He explained that before a genuine move begins, the operators need to clear out the weak hands. They need to trigger the obvious stops, accumulate positions from panicked sellers, and only then allow the price to move in the intended direction. If you're placing your stops at obvious technical levels, you're not protecting yourself. You're volunteering to be liquidity. You're raising your hand and saying, here, take my shares, take my position. I'll sell them to you at a loss right before the move I wanted to capture. So what's the solution? Does this mean you don't use technical analysis? No. It means you have to think beyond the obvious. Wyclof taught that you need to understand the context behind the level, not just the level itself. Is this a level where the operators would actually defend a position, or is it just a place where retail stops are clustered? You need to give your stop-loss room to breathe beyond the obvious zone. You need to place it where you would actually be wrong about the trade structure, not just where the chart looks clean. This requires you to think like the big players, not like the textbook. It requires you to ask, if I wanted to hunt stops before making a real move, where would I push the price? And I know this is uncomfortable because it means your stops might be wider. It means your risk per trade might look bigger on paper. But here's the paradox. A wider, intelligently placed stop that doesn't get triggered is infinitely better than a tight, obvious stop that gets hit right before the market proves you were right. You're not trading to have the tightest risk-to-reward ratio on paper. You're trading to actually make money. And making money means staying in trades that work, even if they wiggle against you first. This brings us directly to the second fatal mistake, and this one is deeply tied to ego and impatience. The second fatal mistake is using stop losses that are too tight relative to market volatility. Now listen, I understand the appeal of tight stops. I really do. Tight stops make you feel safe. They make you feel like you're controlling risk. They let you take bigger position sizes because your dollar risk per trade is small. They create this illusion of precision, like you're a sniper taking surgical trades. But here's the reality. Markets breathe, markets wiggle, markets oscillate, And if your stop is so tight that normal market noise triggers it, you're not trading the market. You're trading your own anxiety. Wyclof observed that the market moves in waves, in springs and upthrusts, in tests and retests. There's a natural rhythm, a natural volatility to price action. And if you don't respect that rhythm, if you try to impose your need for control onto the market's natural movement, you'll be stopped out of trade after trade that would have worked beautifully if you'd just given them room to develop. Think about it like this. Imagine you're trying to catch a wave while surfing, but you're holding the board so rigidly, with such a tight grip, that the moment the water moves unexpectedly, you fall off. That's what a too tight stop does. It doesn't let you ride the natural motion of the market. I want you to consider something that might sound counterintuitive at first. A stop loss that's too tight actually increases your risk, not decreases it. How? Because it gets hit more often. You end up taking more losses, more frequently. Even when your analysis is correct, you're death by 1,000 cuts. Each individual loss might be small, but the cumulative effect, both on your account and on your psychology, is devastating. You start doubting your analysis. You start second-guessing your entries. You start thinking the market is random when really, your stop placement is just incompatible with how markets actually move. Wyclof would tell you that your stop distance should be based on the structure and volatility of the specific instrument you're trading, not on some arbitrary percentage of your account. If you're trading a stock that regularly moves 3% intraday, placing a stop at 0.5% below your entry is almost guaranteeing you'll be stopped out by noise. You have to measure the average true range, the typical swing size, the normal retracement depth, and place your stop beyond that. Yes, this might mean your position size has to be smaller to maintain proper risk per trade, and that's fine. That's actually professional, because a smaller position that stays in a winning trade is worth infinitely more than a large position that gets stopped out for a loss. Let me share something personal here, something I've seen destroy more traders than almost anything else. There's this mentality, especially when accounts are small, where traders think, I need to risk less per trade so I can take more trades and grow faster. So they use these ridiculously tight stops, risk 1% or 0.5%, but the stop is placed so close that market noise kills them. They end up losing 10, 15, 20 trades in a row, not because their analysis is wrong, but because their stops are suffocating their trades before they have a chance to work. And then they blame themselves. They think they can't read charts. They think they don't have what it takes, when the real problem was simply that they didn't give their trades room to breathe. Wyclof's principle here is elegant and profound. He said, if you can't afford to place your stop where it actually should be based on market structure, then you can't afford to take that trade. Full stop. Don't force it. Don't compromise your stop placement to accommodate a position size your account can't handle. Either trade a smaller size with a proper stop, or don't trade at all. This is discipline. This is respect for the market's nature, and it's one of the hardest lessons to internalize because it feels like you're being too cautious, like you're missing opportunities. But the truth is, you're avoiding disaster. You're staying alive long enough to be there when the real, sustainable opportunities present themselves. Now let's move to the third fatal mistake, and this one cuts right to the heart of how most people misunderstand what a stop loss actually is. The third fatal mistake is treating your stop loss as a guarantee of safety rather than a level of invalidation. This is subtle but absolutely critical. Most traders place a stop and then mentally check out. They think, okay, my stop is in, my risk is controlled, now I just wait. They've outsourced their decision-making to a price level. They've abdicated responsibility. And this is incredibly dangerous because it creates a false sense of security. Wyclof understood that a stop loss isn't a magic shield. It doesn't guarantee you'll lose only what you plan to lose. In fast markets, in gapping markets, in news-driven chaos, your stop can be blown through. You can get filled at prices far worse than your stop level. This is called slippage, and it's a real, painful phenomenon that naive traders don't account for. But beyond slippage, there's a deeper issue. If you're using your stop loss as a set-it-and-forget-it safety net, you're not actively managing your trade. You're not reading the price action as it develops. You're not adjusting to new information. Wyclof would ask you this: what is your stop loss actually telling you? It's telling you the price level at which your trade idea is wrong. It's a line in the sand that says, if price goes here, my analysis is invalidated, and I need to exit. But here's the key. That level of invalidation might change as the trade develops. Maybe the market gives you new information. Maybe a new support level forms. Maybe the structure shifts. If you're rigidly attached to your original stop without considering the evolving context, you're trading mechanically, not intelligently. Let me give you an example. Say you enter long at a breakout, and you place your stop below the breakout level because that's where the structure would be invalidated. But then the price moves strongly in your favor, establishes a new higher low, and shows clear strength. At that point, the original stop level is no longer the most relevant invalidation point. The new structure is. If you don't adjust, if you leave your stop at the original level, you're risking more than you need to. You're not honoring the new information the market is giving you. Wyclof's approach was dynamic. He watched the tape, read the behavior, and adjusted his risk accordingly. On the flip side, there's also the mistake of moving your stop further away when the trade goes against you, hoping it will come back. This is the opposite error, but equally fatal. Your stop is supposed to represent your line of invalidation. If you move it because you don't want to take the loss, you're no longer trading a plan. You're gambling and hoping. Wyclof was ruthless about this. He said that hope is not a strategy. If the market tells you you're wrong, you accept it and move on. You don't negotiate with the market. You don't beg it to come back. You honor your invalidation level, take the loss, and look for the next opportunity with a clear head. So the principle here is this. Your stop loss is a tool for defining when you're wrong, not a passive safety mechanism. It requires active engagement. It requires you to read the market, adjust to new information, and remain mentally present in your trades. It's not about setting a stop and walking away. It's about using the stop as a framework for disciplined decision-making. This leads us beautifully into the fourth fatal mistake, and this one is about timing and psychology. The fourth fatal mistake is placing your stop loss too early, before the market structure has fully formed. Now, this might sound confusing at first because you've been told to always have a stop in place the moment you enter a trade, and in general, that's good advice. But Wyckoff's deeper insight was about understanding when you actually enter and where the logical invalidation point is based on the stage of the market structure. Here's what I mean. A lot of traders jump into trades prematurely. They see the beginning of what might become a pattern, and they enter early, hoping to catch the move from the very start. But the structure isn't confirmed yet. The level isn't proven yet. So they place their stop based on an incomplete picture. And because the structure isn't fully formed, the natural testing and probing that markets do ends up hitting their stop, even though the overall idea was correct. Wyckoff taught that you need to wait for confirmation. You need to see the spring, the test, the shakeout, and then the genuine move. If you enter before that process completes, you're guessing, not trading. And if you're guessing, your stop placement is also a guess. Think about accumulation phases. The smart money is building positions, testing the lows, shaking out weak hands. If you enter during that process and place a tight stop, you're going to get shaken out because that's the whole point of the process. But if you wait for the accumulation to complete, for the sign of strength to appear, then your entry is confirmed, and your stop can be placed logically at the point where accumulation would actually be invalidated, which is much clearer and much safer. This requires patience. It requires you to resist the fear of missing out. It requires you to accept that you won't catch the very bottom or the very top, and that's okay. Wyckoff wasn't trying to catch every tick. He was trying to catch the high probability, confirmed moves where the risk was clear and the reward was substantial. He would rather enter late with a clear structure than enter early and get chopped up by the natural volatility of pattern formation. So when I say placing your stop too early, I mean entering before you have enough information to know where your stop should logically go. If you find yourself constantly adjusting your stop because the market is doing something you didn't expect, that's a sign you entered too early. Wait for the market to show its hand. Wait for the structure to clarify. Then enter with a stop that's based on actual invalidation, not on hope or impatience. And now we come to the fifth and perhaps most psychologically devastating fatal mistake. The fifth fatal mistake is using stop losses as a crutch for poor position sizing and emotional trading. This is where it all comes together, where the rubber meets the road, where your relationship with risk and loss gets exposed. See, a stop loss is not a substitute for proper position sizing. It's not a way to take oversized risks and feel safe. And it's definitely not a tool for managing your fear when you're trading emotionally. Here's what happens. A trader feels anxious. They want to trade, but they're scared. So they think, I'll just put a really tight stop, and then I can trade bigger because my risk is controlled. But as we've already discussed, that tight stop gets hit, often repeatedly. Or a trader is on a losing streak, feeling desperate, so they start taking trades they shouldn't, but they justify it by saying, it's okay, I have a stop loss. The stop loss becomes a psychological permission slip to make bad decisions. Wyclof would say this is backwards. Your stop loss should be the natural outcome of a well-planned trade, not the foundation that allows you to take a poorly planned trade. First, you find the opportunity. Then, you identify the invalidation level based on structure. Then, you calculate your position size based on the distance to that stop and your risk tolerance. The stop loss is the last step, not the first. If you're using it to justify a trade that doesn't meet your criteria, you're in dangerous territory. There's also the emotional component. If you're so afraid of losing that your stop is too tight, or if you're so desperate to win that you remove your stop or move it to avoid a loss, your stop-loss management is revealing a deeper problem. You're not trading the market. You're trading your emotions, and the market doesn't care about your emotions. Wyclof was a master of emotional discipline. He knew that the market would test him, would push against his positions, would try to make him doubt himself, and his response was to have a plan, to trust the structure, and to accept losses as part of the statistical process. He also knew that position sizing was sacred. If a loss on a properly placed stop would hurt you emotionally or financially in a way that affects your next decision, your position size is too big, period. Your stop loss should represent a loss you can take without flinching, without revenge trading, without spiraling into fear. If you can't do that, you're not ready for that position size. And no amount of tight stop losses will fix that. In fact, tight stops will make it worse because you'll lose more often, and each loss will chip away at your confidence. Wyclof's wisdom here is about alignment. Your stop loss, your position size, your risk tolerance, and your emotional state all need to be in harmony. If any one of those is out of balance, the whole system breaks down. You can't use a stop loss to compensate for emotional instability. You have to do the inner work. You have to build the discipline and the detachment that allows you to view each trade as just one iteration in a long series of probabilities. So let's bring this all together because I want you to feel the weight and the power of what Wyclof was really teaching. He wasn't just giving you technical tips about where to place a line on a chart. He was teaching you to see the market as a battlefield where information asymmetry, psychological warfare, and capital flow create opportunities and traps. Your stop loss is not a simple risk management tool. It's a statement about your understanding of market structure, your respect for volatility, your psychological resilience, and your ability to think beyond the obvious. The 5 fatal mistakes: placing stops at obvious levels, using stops that are too tight, treating stops as safety guarantees, placing stops too early, and using stops to justify emotional trading. These aren't random errors. They're symptoms of a deeper misunderstanding about what trading actually is. Trading is not about being right. It's about managing risk intelligently, staying in the game long enough to let probabilities work in your favor, and continuously learning from the market's feedback. If you walk away from this understanding only one thing, let it be this. Your stop loss should be placed where you are actually wrong about the market structure, not where you wish you could be wrong to keep your risk pretty on paper. It should account for the natural breathing room of the instrument you're trading. It should be dynamic, responsive to new information, not a static line you set and forget. It should come after your analysis, after your confirmation, not before. And it should exist within a framework of proper position sizing and emotional discipline, not as a band-aid for poor decisions. Wyclof spent his entire career studying how the big players operated, how they accumulated, how they distributed, how they hunted stops, how they created liquidity. And what he learned was that the retail trader's biggest enemy isn't the market. It's the conventional wisdom that sounds smart but actually sets you up to fail. The advice that everyone repeats without questioning. The rules that look good in a textbook but ignore the messy, predatory reality of how markets actually move. If you apply these principles, if you stop making these 5 fatal mistakes, something shifts. You stop being prey. You stop donating your capital to smarter players. You start seeing the traps before you step in them. You start structuring your trades in a way that aligns with how the market actually behaves, not how you wish it would behave. And over time, this compounds. Your win rate improves not because you're picking better trades, but because you're staying in the trades that work. Your confidence grows because you're not getting stopped out of winners. Your account grows because you're letting your edge play out instead of sabotaging it with poor stop-loss strategy. Now I want to talk to you directly, person to person, because I know where you are right now. Maybe you've been trading for a while and you keep hitting this same painful pattern. You do the analysis, you enter, you get stopped out, and then you watch the trade work without you. And it's maddening. It makes you feel like you're cursed, like the market is personally against you. But it's not. You're just making one or more of these 5 mistakes. And the beautiful thing is, these are fixable. You don't need a new strategy. You don't need a new indicator. You need a new understanding of stop-loss placement. Or maybe you're newer, and you're trying to learn the right way from the start. You're watching videos, reading books, taking courses, and everyone's giving you conflicting advice. Some say tight stops, some say wide stops, some say trailing stops, some say mental stops, and you're confused. You don't know who to trust. Let me simplify it for you. Trust the structure. Trust the context. Trust Wyclof's principle that the market is driven by supply and demand, by the actions of large operators, and by predictable patterns of accumulation and distribution. Place your stops based on where those principles say you're wrong, not based on what fits nicely into a risk calculator. And if you're someone who's lost money, maybe a lot of money, and you're wondering if you should even keep trying, I want you to hear this. Every successful trader, every single one, has been where you are. They've felt the frustration, the self-doubt, the anger at the market. What separates them isn't talent or luck. It's the willingness to learn from pain, to question the conventional wisdom, and to align their approach with reality instead of with what sounds good. Wyclof himself started as a kid running stocks on Wall Street. He wasn't born with some special gift. He learned by observing, by questioning, by thinking critically about what actually works versus what people say works. You can do the same. Start today. Go back through your losing trades and ask yourself honestly, was I stopped out at an obvious level that everyone else would also place a stop? Was my stop too tight for the volatility of that instrument? Did I treat my stop as a guarantee instead of a level of invalidation? Did I enter too early before the structure was confirmed? Was I using a stop to justify a trade I shouldn't have taken because I was emotional or desperate? I guarantee you, if you're honest, you'll find that most of your losses fit into one of these 5 categories. And here's the empowering part. Once you see it, you can change it. You can start placing your stops just beyond the obvious levels, in the no man's land where the shakeouts end and the real moves begin. You can start measuring volatility and giving your trades room to breathe. You can start staying present in your trades, adjusting your stops as structure evolves, not rigidly clinging to a predetermined line. You can start waiting for confirmation before entering, resisting the temptation to jump in early. And you can start sizing your position so that a proper stop doesn't scare you, so that a loss is just data, not a catastrophe. This is the path. This is what Wyclof taught. And it's not easy because it requires you to think differently than the herd. It requires you to be patient when others are impulsive, to be strategic when others are reactive, to be calm when others are panicking. But that's exactly why it works. The market rewards those who see what others don't, who act on principle instead of emotion, who respect the game enough to play it correctly. I want to leave you with one final thought, one final image. Imagine yourself 6 months from now. You've internalized these principles. You're placing your stops intelligently, based on structure and context. You're giving your trades room to develop. You're staying in your winners, cutting your losers at logical points, and your equity curve is starting to climb. Not because you found some magic indicator, but because you stopped sabotaging yourself. You stopped making the 5 fatal mistakes that were bleeding your account dry. How does that feel? How does it feel to trust your process, to respect the market, to trade with confidence because you understand what you're doing? That's available to you, right now, not someday. Not after you take another course or find another strategy. Right now, by simply applying what Wyclof taught about stop losses. These aren't secrets, they're principles. And principles, when applied consistently, create results. So take this knowledge, go back to your charts, and look at your stop placement with new eyes. Be ruthless in your honesty. Be willing to change. Be patient with yourself as you learn, because trading is a skill, and skills develop through deliberate practice and thoughtful reflection. Thank you for being here, for listening, for caring enough about your trading to seek out deeper understanding. That curiosity, that willingness to learn, that's what will carry you through. Keep studying Wyckoff. Keep questioning the conventional wisdom. Keep aligning your actions with how the market actually works. And most importantly, keep moving forward. One trade, one lesson, one moment of clarity at a time. The market will always be here. The opportunities will always come. Your job is to be ready, to be smart, to be disciplined. And now, with these 5 fatal mistakes identified and understood, you're one giant step closer to becoming the trader you were meant to be.